This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to this week's AJ Bell Money and Markets podcast. Once again, there is so much to get through, not least the state of automakers, both here in the UK, where Ford and Stellantis have announced job cuts, but also globally if Donald Trump goes ahead with chunky tariffs on Canada, Mexico, China, and potentially the rest of the world. With me this week is Laura Suter. Hi, Laura.
Hi, Danny. And once again, we've got two special guests on the podcast this week. First, Imogen Harris, who is fund manager at Premier Miton Investors, and she talks to Dan Coatsworth about finding the best opportunities in smaller companies. And Dan is also catching up with Nick Clay, who is a portfolio manager at Red Wheel, about where to find global income and how to avoid becoming a growth investor in disguise.
And have you started your Christmas shopping yet? Lots of people have been making the most of Black Friday sales, but are those deals really deals?
And as Bitcoin hits record highs and the number of people in the UK owning crypto rises, the Financial Conduct Authority says it's going to consult on plans to regulate the sector.
But first, let's start with car makers because it's been absolutely across all newspapers, news websites, TV programs over the last few days, the state of the UK car industry. And first of all, I must say to those 1,100 people who stand to lose their job with the closure of Stellantis plant in Luton and also the 800 workers who stand to lose their jobs because of a previous announcement by Ford. I mean, my heart absolutely goes out to them. But of course, for Luton in particular, it's the whole supply chain that is potentially going to be impacted by this decision. And it's really hit workers hard because there had been expectation that Stellantis would invest in the shift to electric van making at this plant in Luton, but has now said, no, we are just going to focus on Ellesmere Port, which is the UK's first and only electric-only manufacturing plant, and that Luton plant is due to close. Now, we've heard from the business secretary, Jonathan Reynolds, saying he did everything possible to stop the closure. But part of the reason that Stellantis has said that they are making this decision is because of these charges which are being levied on automakers if they don't hit targets towards net zero. We know by 2030 the government wants to stop the sale of all new petrol or diesel cars. But as we hurtle towards that, automakers are being fined if they don't hit targets. So this year, it's 22% of cars, the government says, need to be electric, zero emission. And at the moment, we're talking about 18.7%. And that means, in real terms, for every car over that sold, the automaker has to pay a £15,000 fine or pay another automaker, like one of the big Chinese, BYD, etc., or Tesla, to take the credits from them to do it. And we've had warnings from lots of these car makers that this shift, although they completely understand the ambition and they understand the target, the way that it's being delivered at the moment, considering the fact that the consumer just doesn't seem ready to go that far. We've had a cost of living crisis, which has made people really think about their cash. For some people, electric just isn't the way. I mean, I don't drive an electric car, Laura. I don't have anywhere that I could plug in my car overnight to charge. And for me at the moment, it's a barrier. What about you?
Yeah, same. We need to get a new car because ours is rapidly falling to pieces. And I feel like an electric car is a good, obvious choice, particularly because I live in a city. So there are places that you can charge. But I still have that kind of anxiety around, okay, well, what if we did a long journey or drove to, the in-laws' house, which is very far away and isn't so well equipped with the infrastructure. I think a lot of people feel like there's not quite that infrastructure around it for them to make that leap. And so I guess the hybrid space has been very popular, and that's kind of the middle ground, isn't it, for lots of people?
Yeah, I know that Ford are asking for the government to, not just deliver a stick, which they've got at the moment, sort of bashing automakers with these fines, but also to give us, the consumer, more of an incentive, some kind of deal which persuades us that either we want to invest in putting charging points outside our home if we can, or to buy the cars themselves. And I actually drove an electric car for the first time when we went on holiday to Norway, and I really liked it. And I found charging much quicker than I thought it would be. But it was a bit of a faff because you had to have 2 or 3 different apps because the charging places all had different companies connected with them. You couldn't just, ship up and, the way we do with petrol at the moment, you can go to any petrol station as long as it's got petrol or diesel, whichever you need. And it doesn't take very long. You can just use any of the pumps. Whereas I know a lot of people say that, they don't have access to rapid chargers. And if they're doing those long journeys, sometimes they have to wait a long time for one of those chargers becomes free. But I know that there are now big questions about whether or not this investment, we saw quite a lot of companies like Jaguar Land Rover, Nissan, Aston Martin last year, all talking about investing in the UK car manufacturing sector. But now I've seen a lot of newspapers questioning whether or not this is really crunch time once again for automakers in the UK.
And not to pile more bad news on the sector, but car makers are also likely to be one of the sectors hardest hit by Donald Trump's tariff proposals, aren't they?
They are, yeah, absolutely. I think we saw markets jump up quite considerably last week on the news that Donald Trump was appointing Scott Bessent to be his guy at the Treasury, effectively the Chancellor in the United States. And he's known as something of a moderate. So there was sort of this expectation that just maybe having this Treasury Secretary in place would mean that Donald Trump wasn't going to come out all guns blazing, that he was actually going to use tariffs as a negotiating tool. And then suddenly he comes out and says, right, day one, immediately, as soon as I'm done with my inauguration, before the last of the confetti has dropped on the floor, I'm heading back into the Oval Office and I'm signing in 25% tariffs on Canada and on Mexico and an additional 10% on China. Now, we assume that that is just a jumping off point, but who knows at the moment? It will mean that many businesses are going to be impacted, but yet automakers in particular are seen as potentially being the worst hit. And we had the Mexican president coming out yesterday saying, look, if the United States raises tariffs on us, then we will have to retaliate by raising tariffs on stuff coming in from the United States, and also pointed out that a lot of US car makers, particularly the likes of General Motors, which of course is huge in the United States, they make a lot of cars in Mexico and then import them into the United States, or even just some of the parts come from all over the world in order to make those cars in the United States themselves. So the potential impact of automakers from these tariffs is absolutely massive. And we know that automakers have been having a real difficult period of time anyway, because automakers have had to change from what they've done from years and years, build combustion engines, into now these new electric vehicles. And it's a different way of building, and it's different parts and different costs involved. And of course, that has impacted their margins, which is why we're seeing job cuts, not just in the UK, but also, we've seen a number in Germany in particular has been really badly hit. But these tariffs potentially could be an absolute humdinger for a lot of these companies.
And there's kind of divided opinion on the tariffs, isn't there? There's some who think that Trump will stick to his guns and will bring them in. And there's some who think that he's using it as a threat to get people kind of to the negotiating table to agree deals. And so I think it'd be really interesting come 2025 to see how all of that plays out.
I tell you what, Laura, it might impact your cup of coffee because I did see that coffee prices had gone up to a 50-year high. Yes, because there have been issues with Brazil harvests and concern about the amount that's around next year. but also because some coffee users in the United States have now started to stockpile. So if you drink coffee, you better watch out.
I mean, that is enough to terrify me into stockpiling. I can't do without my coffee. But let's stick with markets for now. We've had quite a bit of takeover news this morning, haven't we? So we're recording this on Thursday morning. Danni, what's the update there?
Yeah, it's been a real busy day for takeover news, and some quite interesting movement has been happening. And I've heard words like audacious used to describe the fact that we have Aviva announcing that it is trying to take over Direct Line in a deal worth 3.3 billion pounds. Now, Direct Line has immediately come out, the board, and says, look, it substantially undervalues the company. It's highly opportunistic, effectively saying, go away again. But I don't think anyone expects that this is going to be the end of it. Now, if you remember, Direct Line, this isn't the first time that there has been takeover interest for Direct Line. Earlier this year, we had Ageas offering 3.17 billion. So this offer from Aviva is substantially higher. We know now that under takeover rules, they've got until the 25th of December to make a firm offer. And when you're looking at where shares closed last night, this is a 60% premium. And although the board is saying, look, it's been a tough couple of years, and they have announced big cost-cutting measures, 550 jobs are due to be slashed, but we know that I think it's 35% drop in the number of premiums that they've got for their motor sector. And that is because prices have been high because we've had inflation, but also because people are sort of casting around and trying to go for the cheapest offer. And Direct Line has still got some work to do. It has brought prices down. But it's been fascinating to see the reaction to this. And shares were up a whopping 38% on the news. They had been down 14% since Ageas announced that it wasn't going to go any further. But I think the expectation is that maybe Aviva will sweeten the deal and this might go through. But at the same time, we also had an update from Loungers, the pub and restaurant chain, and no doubt there as to which way it's going to jump. It has said it is backing a £338 million takeover bid. This is from the New York investment firm Fortress. It's going to be a well-known name to a lot of you. It owns Punched Pub Company and Majestic Wine. And Loungers says, look, we've got 270 locations now. We've got a whole number of different brands, including Brightside, Lounge, the Cozy Club. And it also announced latest update. And half-year sales were up 19%, pre-tax profit up 50%. And yet it says, look, we're still undervalued. And we just feel that illiquidity is a structural issue to many UK small caps, and that has been reflected in the market value, and they just think that they would do better looking elsewhere. And I think that this is something that we're seeing from a lot of small UK companies, a real concern about the amount of money that is going in to invest in those companies.
That'll be an interesting trend to follow into 2025, I think, the takeover trend and also what happens with smaller companies. But whilst we're talking about smaller companies, let's hear from our first guest. Imogen Harris is fund manager of the Premier Miton Global Smaller Companies Fund, and she's been chatting to Dan Coatsworth about where to find the best opportunities when it comes to smaller companies and why a $22 billion company is considered to be a small cap in the US.
So I'm here with Imogen Harris from Premier Miton's Global Smaller Companies Fund. Imogen, great to have you on the podcast.
Thanks very much.
There's a really important question which lots of people ask when looking at smaller companies' world is if in the UK, what investors were classified to be smaller companies is completely different to perhaps what someone in the US or other parts of the world would consider to be. In your fund, you've got a stake in Booz Allen Hamilton. It's worth $22 billion. Now, if that was in the UK, it would be in the FTSE 100. But it sits inside your small cap fund. Why is there such a difference between the definition of what a smaller company is?
Yes, and I think for us that's a question of how you define a smaller company. So we're a global fund and we want to be able to be invested across the world, developed markets and emerging markets. So our definition of what a smaller company is actually by percentage within its own market. So it's the bottom 15% of the index by market cap. So that means a smaller company in the US can look very different to what a smaller company in Portugal looks like, or the Philippines, or Japan. And so that's why we have this differential of what a smaller company means, because a smaller company looks quite different across different countries across the world.
So I think if we look at what's going on in the market, I think just over 12 months ago, there's a real shift in sort of investor appetite, investor sentiment. I think lots of people were really expecting interest rates to fall. They seem to be happy to take more risks. And so we've seen a sort of more interest in the smaller company space. More recently, we've had a shift again in interest rate expectations, that interest rates might actually stay a little bit higher for longer. Do you think that threatens to dampen appetite in smaller companies near term?
I think the key for small cap performance tends to be earnings growth, and tends to be earnings growth that is higher than the larger cap space. So for us, anything that improves economic activity will improve that uptick in investor sentiment, and whether that's the yield curve falling, whether that's higher economic activity, then sometimes on the company basis, whether that's things like product launches or a better funding environment, all those aspects are things that tend to drive smaller company performance. So it is true that higher yield curves tend to maybe slightly dampen that activity. But I think for us, sometimes it tends to be a picture where maybe rates are more stable, as opposed to having this quite volatile funding environment. We really want to be able to see a stability of economic conditions, and maybe sometimes that might be a little bit higher for longer, but at least it has a greater predictability about it, which is much more easier for companies to plan.
So with your role as a fund manager, when you look for a sort of a company to invest in, what qualities are you looking for? Is it simply you want to find something that can grow faster than the largest, or the company or the market leader in that space?
I think for us, when we're looking for companies, when we're looking for ideas to invest in, there's a few elements that we want to be able to see lining up. I mean, firstly, in the global smaller companies space, we think what you describe as quality, a company with quality characteristics, is really important. So sometimes that's a company with strong competitive advantages, where, it's simply put, its sort of products and services are better than the other companies, than its other competitors. Or you want to be able to see a company with really strong cash generative. So we really like aspects like that. Then the second key aspect of what we're looking for is what we term positive earnings momentum. And really, we describe that as the phenomenon where it isn't just profits that drive share prices, it's upgraded profits that drive share prices. So our idea generation is based around some of these two key factors, and we think they work quite symbiotically together, where companies that have these quality characteristics are the ones that tend to be able to sort of beat the market and beat the market on the upside. So interestingly enough, even though these companies that we're investing in are small, actually sometimes they can be the leader in their industry or the leader in their niche, or they have a particular product quality where they are able to beat those larger cap competitors.
So you've got about just under 40% of your assets in North American companies. So what does the new era under Donald Trump again mean? Because obviously he wants to relax regulation, cut taxes. It seems to be a better environment, particularly for domestic companies. Does that create a sort of tailwind for the type of companies in which you're invested?
Yeah, so we have 40% of the fund investing in the US at the moment. So that does mean we're underweight our benchmark. And really, the reason why we've been set up like that so far is because although there is a lot of economic growth in the US, there are some areas of the industries that we really like. The valuations in the US have been particularly expensive. And certainly over the summer, we saw some weakness in US data coming through, brought those valuations down a little bit. So for us, the asset allocation isn't necessarily done from a top-down perspective. We're sort of fundamentally, we're bottom-up stock pickers. So it's based on that balance of how much do we like the company, do we like the industry, what's the valuation looking like, and do we see sort of upgraded prospects within the company itself. So for us, this sort of the new Trump era It affects really the latter, where we can then analyse particular industries and see how the expectations have changed for the various companies that we would own. And then if we do increase our weight in the US, that tends to be a bit of a stock specific reason.
Yeah, I mean, obviously, we're Trump coming in clearly has relevance to US companies, but also actually to companies around the world. So the idea that there's certainly talk of imposing tariffs on foreign goods imported into the US. Well, that might have a negative impact on European companies. So I guess in your portfolio, do you have European companies that sell into America, and is that sort of got you thinking about potential cut to their profit margins or anything like that?
So yeah, we're a global fund. We invest across the developed markets, Europe, UK, but also in emerging markets, China and other parts of the emerging markets. And the key location, the key region that Trump has said he would put tariffs on is China. So the really interesting thing is, in the aftermath of Trump winning the election, we've spoken to a few of our companies, and some of our companies have had results. And I think nowadays, particularly after the cost inflation crisis we saw in 2021, and particularly also after the COVID crisis, obviously, 2020, a lot of companies have much more flexibility in their supply chains. And this sort of deglobalization that we've been seeing happening in the world over the last few years has actually meant that companies are already aware of the fact that they've had to diversify their supply chains. So it's been really interesting how many companies have come out in the aftermath and have said, oh, actually, this is what our exposure to China is, and this is how quickly we can actually move our US sourcing away from China. So I think the commonality, I would say, that we've seen post-Trump, whether that's European companies, US companies, is that greater flexibility in the supply chain, certainly than they had at least 5 years ago.
So as we sort of move into 2025, I mean, how are you feeling generally? Are you quite upbeat, optimistic about sort of the year ahead for an investment perspective?
I think we certainly are. At this stage of the investment cycle, we think small caps do offer a really attractive opportunity for investors. If the global economy does improve going into 2025, and I think maybe it might not feel very positive at the moment, but if we just think back to 23, 22, 21, we are on an upward trajectory. So with small caps, you get an earnings stream that, if we do see growth coming through, can grow faster than large caps. And certainly 2024 was the year of the election. So when we have policy certainty within the global economic world, there is, that is a better environment for economic activity to take place in. So in general, we are pretty upbeat about the small caps. We see the pieces of the puzzle for growth coming into play.
Well, Imogen, thank you ever so much for joining us. It's Imogen Harris from the Premier Miton Global Smaller Companies Fund.
Thanks very much.
Imogen Harris, Fund Manager, Premier Miton, talking to Dan. Now, Laura, consumer sentiment is hugely important to lots of companies, but in particular, hospitality, we heard there about loungers, and also retailers. And I know the BRC has said this morning that confidence is looking pretty weak as we head into Christmas. Lots of people thinking about their budgets, maybe looking for deals, but there are also warnings that people could be being scammed.
Yeah, unfortunately, Black Friday, whilst it's great for snapping up a deal, is also a bit of a scammer's paradise, because lots of people are buying things quickly, they're pouncing on deals, and they're maybe not doing the thorough checks that they would usually do. And so there were some figures out from Lloyds Bank that showed that the number of purchase scams rose by 29% around Black Friday and Cyber Monday last year. So purchase scams are where someone's tricked into sending money via a bank transfer to buy something that often doesn't exist. And quite often these things are advertised online or via social media. And it's that kind of rush and excitement of bagging a deal means that lots of people do not check, is this website legit? Is this deal too good to be true? Is there something a bit fishy about this? Because we know that often in Black Friday, there's good deals to be had, but there's often not loads of product to buy. So, it's a good deal to be had on a new TV, but they've only got 20 of those TVs to sell, for example. And so that does mean that people kind of rush through. But there are some easy ways that you can try to avoid being scammed this Black Friday. So the first one is to not hurry too much. Obviously, you want to try and pounce on that deal, but not at the expense of being scammed out of money and losing a load of money. Do things like buy from trusted brands. And even when you are buying from trusted brands, check that the web address is legitimate, because some scammers will set up websites, with the same branding as one of the big brand names, but actually it will be a scam site, and the web address will often give that away. And then use a card, a credit card if you have one, or a debit card, so you get some level of protection when you buy things. So if something turns out to be a scam or some product's not delivered, then you have some protection offered through those cards. And I think the final thing is to, be really wary of social media posts. That's where lots of scammers operate. It's where lots of us see good bargains, but you can end up thinking that something is from a legitimate brand on social media, clicking through, and then you end up in this dodgy website. And as always, be wary. If the deal seems too good to be true, then it probably is.
While we're talking scams, Laura, as well, I know a lot of people are thinking about filing their tax returns. And I'm sure, well, I'd certainly be delighted if I heard from HMRC that I'm actually in line for a rebate. But scammers are at work here as well.
Yeah, so nearly half of the 145,000 scams reported to HMRC were fake self-assessment rebates. And so lots of people probably will have received this. I know I have, where you get a text saying, hey, you've got a tax refund, click here to claim it. Or you might get an email, social media post, all of these things. Last year, we saw a record 11.5 million taxpayers file self-assessment tax returns. And part of the issue is that lots of people are filing tax returns for the first time due to changes with different tax allowances or with the tax system. We're seeing lots of first-time self-assessment filers, and that means that they might be a bit more susceptible to scams because they're not used to the usual way of operating. And for example, knowing that HMRC would never really contact you by text about a rebate. And as we've got the deadline of the 31st of January nearing for that self-assessment return, it's a good time to be very scam aware. So definitely make sure you're on a gov.uk website so that you're on the legitimate website, and be really wary of any text messages, emails that look a little bit fishy or that are promising you a rebate. All of your rebates would normally be communicated from HMRC through letters. They're quite old school, our HMRC, rather than you getting a text out of the blue saying that you've got this. So it's just another warning around this time of year, and obviously Christmas as well, to be very scam aware, because it's when those fraudsters really do ramp up their activities.
It is. And I actually got a text message quite recently just saying it's time to file your tax return. And that kind of threw me because HMRC usually does everything via letter. But I must admit, I would, if that was a scam, I would be susceptible because it comes up HMRC and you just think, oh, so yeah, you do need to be so incredibly cautious. Um, Something that we've been speaking a lot about in my house, oddly, is cryptocurrency. I've got two teenage daughters, and cryptocurrency is something which is really popular among younger people, which astonishes me that they're talking about it, but also really worries me. And certainly, following Donald Trump's US election victory, we've seen Bitcoin values absolutely soar. Now, that's the most well known cryptocurrency, and it is now within touching distance of what is a psychologically important $100,000 milestone. It wasn't that long ago when I saw a guy in the United States had used 10,000 Bitcoins to buy just two pizzas. So this just goes to show you
He's regretting
how
that now.
things, I bet he is, just goes to show how things have changed. But it is still incredibly volatile. We know that Donald Trump, who had been a crypto skeptic, is now saying that he wants to make the United States the crypto capital of the world, which is why, of course, we're seeing this surge at the moment. Although I have noticed it's come down a bit in the last couple of days. So it's hovering around the $95,000 mark. But it is certainly now something which is becoming more mainstream in the United States. We've had a number of big name investment companies like BlackRock introducing exchange traded funds. And I noticed that BlackRock put out a comment last week saying that in terms of assets under management, their Bitcoin ETF was now more successful, had more cash in it than their gold ETF, which just sort of goes to show the direction of travel. But certainly here in the UK, there is still an awful lot of caveats.
Yeah, I mean, it's definitely growing in popularity in the UK. We had some research out this week from the regulator, from the FCA, showing that the number of UK adults owning crypto has risen from 10% to 12% of UK investors. And the average value of crypto held by people has increased from almost £1,600 to almost £1,850. So it's not just, I mean, for some people it will be, but it's not just the odd, 50 quid, 100 quid that people have got in there to dabble around with it. Some people have put really decent amounts of money into cryptocurrency. But what's worrying out of that research is that a third think that they could raise a complaint to the FCA if something went wrong. And that just isn't the case. It's an entirely unregulated sector. But the FCA says it's now going to consult on regulating the sector. So there's this weird mishmash of rules at the moment where the FCA regulates some crypto promotions, so adverts for crypto, but it doesn't actually regulate crypto. And there's kind of some negotiation that needs to happen between Treasury, the government, and the FCA on how they do this. But considering it's been really growing in numbers in the UK, it feels like something that they really need to grasp.
It does feel like something that they need to grasp. And I do think that it's about time that they are doing it, but it is quite late. I mean, it feels like they've required a proper framework for this asset class for a good couple of years, but they kind of kicked it into the long grass, really. And it was nice to see that the Director of Payments and Digital Assets of the FCA, Matthew Long, was saying, look, we need a framework which is safe, sustainable, and competitive. But when you're thinking about 12% of UK adult investors who now have cryptocurrency, without the proper framework, without the proper protections, and a third of those thinking that they do have protections, it is incredibly worrying, particularly when you consider how volatile crypto is. And I was just taking a look. So the last time that we sort of hit highs of around the £60,000 mark was back in October 2022. And then, of course, it tumbled upon the news that the FTX Sam Bankman-Fried founder had been jailed for fraud, and it went down to around 15,000, which just goes to demonstrate how volatile that particular area is. And I still think that for investors in the UK, you need to think about the money that you put into cryptocurrency. If you can't afford to lose it, you're not prepared to lose it, then don't invest in it at the moment until the FCA gets itself into gear.
And we've talked a lot about scams on this episode, and crypto scams is a huge area as well. And so it's another thing of, if you're a relatively inexperienced investor and you're deciding that you want to buy crypto, you need to do a lot of checks to make sure that you're buying it from a legitimate place. And I thought the FCA had a very good tip, which was that whenever you invest in crypto, you should see prominent warnings about the risk of losing your money, and you shouldn't be offered any free gifts to join or bonuses to refer a friend. And I really think that's an important thing to bear in mind if you are going to go out there and buy crypto, to avoid the huge number of scammers that operate in that area as well.
Now, before we hear from our last guest, Laura, let's talk savings rates and in particular premium bonds, because that is hugely popular.
Yeah, they are known as Britain's most popular savings account, and a huge number of people have their money in premium bonds. But NS&I, which runs them, is cutting the rates on them and on a number of other accounts. So from the 20th of December, the rates on NS&I's direct saver account will reduce from 3.75% down to 3.5%. And the provider's income bonds will also see their interest rate cut down to 3.49%. And then on top of that, what's called the expected prize fund on premium bonds will reduce to 4.15% in December and then down to 4% in January next year. This effective prize fund rate is a bit weird, but it's calculated based on the average payout of premium bonds, because premium bonds obviously do not pay an interest rate. You get put into a prize draw and you could win money each month. So to give a comparative figure, they work out what the average bondholder with the average odds would win and get as an effective return. And so that's what we're talking about there. But it's cut that rate a number of times this year. We saw it rise pretty dramatically during that savings bonanza as interest rates rose. And now it's been successively cutting it back. Now, how it effectively does that is the odds of winning premium bond prizes will remain the same. So they're 22,000 to 1. But what NS&I has done is reduce the number of prizes at different levels. So, for example, the number of £100,000 prizes that are available each month will drop from 89 down to 82. And it's a similar case. And then the number of very small prizes, so, the £25 prizes, they've increased. And all of that means that you have a kind of a lower expected return on that money. And I think it's another reminder to just think about, premium bonds are hugely popular, but you're not getting a guaranteed return on that. That expected prize fund is being whittled down a little bit. And we did a previous Freedom of Information request at AJ Bell, and it revealed that 2/3 of premium bond holders have never won a prize. And I think that's a really important thing to bear in mind. And because it operates a bit like a lottery, the more tickets you have, the more likely you are to win. And so how that translates into premium bonds is the more you have in the accounts, the more likely you are to win. And so if you've just got a really small amount or relatively small amount in premium bonds, then your chances of winning are relatively lower. And it might be worth considering a kind of more traditional savings account. So I think when these rates are cut, it's always a good chance to think, is this account right for me now? What could I get elsewhere? And do I want to switch?
I have to say, I'm one of those who never won anything. My dad gave me a small number of premium bonds after I had my first child, and didn't win and moved them over to a much better account for me. And I know savings is something a lot of people have been talking about. We've been talking about interest rates, the base rate, and the fact that some mortgages actually put up their rates following the base rate cut, but there has been some better news.
Yeah, it's always good to end on a bright spot, isn't it? Yeah, what
Unusual.
we've I know. What we were seeing was, mortgage rates rising and savings rates being cut, and people were thinking, wait a minute, these are meant to go in step with each other. But what we have seen is Barclays, so one of the big major lenders, the first one since October to come out and announce big mortgage rate cuts. So it's cut rates by up to 0.2 percentage points, which sounds teeny tiny, but actually in the mortgage market, that makes a pretty big difference, particularly over the full term of the loan. And so we had been seeing, like you say, Danny, those hikes from other major lenders. So it's very encouraging and positive news that we're seeing one of the big lenders come out and cut rates. And what we would hope is that this could spark more lenders to cut rates, because we know that lenders operate on what the interest rate is at, what the future expectations for interest rates are at, but they also operate in a competitive environment. And if they want to get more customers through the door, more mortgages sold, then they may cut their rates to attract more people through the door. So brokers generally feeling pretty positive about this, and that we might end up with more cuts from other major lenders before the end of the year. So fingers crossed for that Christmas treat.
Oh, I like a bit of good news to round things up. But before we go, we've got time to hear from one last guest. Nick Clay from Red Wheel Global Equity Income Fund has been chatting to Dan Coatsworth about targeting global income, why some investors end up falling into the trap of becoming a growth investor in disguise, and whether companies now care more about share buybacks than dividends.
Well, I'm pleased to be joined by Nick Clay from Red Wheel Global Equity Income Fund. So Nick and his team used to be with BNY Newton. So Nick, thank you very much for joining us.
Thanks for having me.
So Nick, I want to start the conversation by looking at dividends versus share buybacks, because I know that when interest rates were low, investors seemed to welcome strong dividend growth, but now they seem to be sort of really interested in share buybacks. I was wondering if you thought that companies have sort of spotted this sort of shift in the market and are now prioritising buybacks in the hope that itself will attract even more investors.
I think that's true. Certainly in America, they have adopted share buybacks, and it's starting to pick up in Europe and, dare I say, in the UK too. There is a problem with that, though, which is that you can't equate share buybacks and dividends together, because they do very different things. On a piece of paper, in a textbook, they are just a way of returning value back to whoever's receiving the dividend or having their shares bought back. And it should be that implies a discipline upon the management of a company to return capital to shareholders in a disciplined fashion, which should benefit the long-term owners of that business. However, in reality, that isn't what happens. So dividends at a very good company do tend to be durable and stable throughout time and can grow through time. They do exactly what they're meant to do. The data and the evidence from share buybacks in the main, and of course in America where they're doing the most of this is where this data is coming from, is that you always see the majority of share buybacks happening at the peak of markets, but not at the bottom of markets. Well, from a shareholder's point of view, it's at the bottom of markets you want them to buy the shares back, not at the peak of markets. Equally, they tend to issue a lot of debt in order to buy back the shares. And therefore, you're just putting more debt on the company in order to buy back the shares. But then that would be fine if they cancelled the shares and the share count got smaller. But they don't do that either. And all they're really doing is using the share buyback to offset the dilution of shares from the option schemes that are paying out to the senior management of that company. So basically what's happening is the company's management are borrowing money, giving that money to the company, and then giving that money to themselves and leaving the company with all the debt so they can go and buy a space rocket. It's not in the interests of the incumbent shareholder. And so there is undoubtedly this trend to go more to share buybacks, but I actually think it's a bad thing, because I think dividends do far more profound things for the investor, but also impose a discipline upon the management of a company and how they allocate the capital. And I think it's a sad thing if we just keep going down the share buyback route.
Okay. I mean, it does feel like companies have got lots of demands on their cash flow, whether that's investing in AI, in sort of improving their infrastructure, even things like having more efficient operations, more efficient warehouses. Does that sort of threaten the outlook for dividends next year?
I certainly think the increase in costs being put upon businesses, whether it be a demand for them to have to invest for growth, but actually also the demands that governments seem to be putting, well, certainly outside of the US, where taxes are going up for corporates. In the US, it's going to be the opposite under Trump. But the demands on a company's cash flow are growing. And so that's why it's quite important when you're investing in the dividend world that the quality and the nature of your company is such that it can suffer, is the way we phrase it. It can suffer all these things. It can suffer to invest, to be able to continue to grow and support its margins, support its cash generation, and at the same time still be able to generate a dividend and be able to grow that dividend. Now, obviously, the companies that can't suffer are the ones that end up therefore cutting their dividends or slowing them right down. And particularly when things get really bad, were we to go into a recession, heaven forbid, then obviously those weaknesses come very much to the surface. And I think that's the sort of right at the heart of it, the catch-22 of income investing in equity markets, is that it's not as simple as just go buy a company that pays a dividend. Because actually the companies that pay a dividend have a nice, high, attractive starting yield, well, they're on a high and attractive starting yield for a reason. Chances are those dividends are not sustainable and durable over time. And so you do have to be very active in the companies you select. You can't really do it in a passive sense. And certainly the pressures that are growing on companies today, whether it be government-led or whether it be capital intensity-led through having to invest in things like AI, will put some of those weaker companies at pressure.
I mean, we've seen a bit of a trend recently with some companies cutting their dividends. There's names like Estee Lauder, BASF, Intel, Burberry. I mean, is this a sign of things to come on a broader scale, or is that simply just examples of companies that are just going through a sort of a troubled patch?
I think it's more the example of companies going through a troubled patch. There are always companies cutting their dividends. I think early in the year, some of the mining companies were doing it too. But it basically means that when their backdrop market becomes difficult, if they are fragile companies, then they can't suffer and they end up cutting their dividends. Now, what I do think it shows, though, is that unlike many years ago, where there wasn't a lot of disruption and companies really did stay around for a long time, you tended to get less of that back then. But today, because disruption is so great, the average tenure of a company today is only about 18, 16 years or so, where it used to be like 60 years back in the 1970s, means that you might get more regularly companies falling into this trap where their businesses have been disrupted and therefore are unable to generate the cash flows to support a dividend over time. And invariably what happens with those companies is they stretch themselves at the beginning to keep paying the dividend, which actually puts them in a weaker position. And then that's what puts the pressure to bring the dividends back down.
Yeah, okay. I mean, one of the biggest competitors for an equity income fund is actually just a cash savings account. I know that we've seen pretty decent returns on cash in the last couple of years, but cash rates have been trending down with expectations for interest rates. But last couple of weeks, we've seen those expectations change, and it's sort of there's some indication that rates might actually stay sort of relatively higher for longer. So why would someone actually want to put money into an equity income fund now if cash does actually stay appealing for a little bit longer?
Yeah, certainly. And when you've come out of a long period of zero interest rates, 4% in cash suddenly looks really attractive. And I would say that cash actually is very attractive if the outcome that we face is a recession and everything comes under trouble. Then you want to hide somewhere, and quite frankly, hiding in cash at 4% is probably not that bad an idea. The problem is what if that isn't the outcome? And in fact, what the data that's shown recently, and also when you look at government policies, whether it be in the UK, and they want to spend a lot more, they're obviously taxing a lot more too, but they want to spend a lot more, or in America where they're taxing less and they want to spend a lot more, all of this increased spending tends to be inflationary. And so the problem with parking your money in cash is it's not really an investment decision. It is a short-term, I'm scared of something and I just want to hide somewhere, fine. But over the longer term, any serious length of time for an investment time horizon, the problem of inflation means that cash is probably the poorest investment vehicle you can choose because it just cannot keep up. Now, the reason why interest rate expectations have gone from they were all going to be cut really nicely, thank you very much, to now they're going to stay higher for longer is because inflation is proving a lot more stubborn. It came down quickly, but it's that last mile of getting us down below 2% is becoming harder. And many of the government policies around the world are inflationary. And so if you have inflation come back, sitting your money in cash is really not going to help you. I mean, back in the 70s, when we had loads of inflation and cycles of it, cash was the worst performing asset class over that decade by a country mile. So it's not really an investment decision. It's somewhere to park your money if you're scared short term. But if you've got to think longer term about investing, then you want something that can keep up in an inflationary environment. Well, the thing about dividend companies, and I know we've talked about lots about cutting dividends, but if you're in the right companies, they can grow their dividends. And back in the 1970s, the 12-month rolling dividend growth of the S&P kept up with inflation, which was one of the few things that did. A couple of real assets did, but that was about it. And so you're able to suffer that kind of environment. And that's what you need when you're thinking about long-term investing is how am I going to keep up in a real sense, keep up with the inflation. You can do that through the growth in the dividends from these companies, which is something cash definitely can't do for you.
Okay. And the UK accounts for about a fifth of Redwheel Global Equity Income Fund. I know a lot of people talk about the UK being unloved, but actually it's always been a pretty good place to find dividends, isn't it? I mean, do you think this is always going to be sort of a real key component from a geographical perspective in your fund? Or actually, are there signs of other parts of the world that could be really strong places to get dividends and importantly, dividend growth?
So, I mean, this strategy has been in place since 2005. So, next year will be 20 years. And over that period, the strategy has been overweight and underweight every geography available to it, apart from Japan. It's been permanently underweight Japan over that period. And the reason for that is we go where we find good value, and that tends to coincide with higher dividend yields. So you're right, the UK looks cheap at the moment, and therefore yields on a relative basis to everywhere else look attractive, whereas it's very low in the US, so we've got a big underweight in the US. That will move over time. One hopes that the UK can start to perform, and then the yields will fall, and so we'll move out of the UK and something else. So it's not that it's always permanently going to be a high proportion of the strategy. It just is today. What's interesting over that almost 20-year period now is how the growth in dividends has been seen in Asia and emerging markets. When we started and before, even that time, much of the income to be found in the global markets was found in the developed markets, the US, Europe, and the UK. Whereas today, over 50% of all the dividends in the world come from Asia and emerging markets, which is a dramatic shift. And so when we say we're global, we truly do have a global set of opportunities to choose from. And so where we get our income from is not restricting us in anywhere where we go to find ideas. That's dependent on how cheap are those good companies, and is it the right time to be buying them. At the moment, as you said, the UK looks fairly attractive.
Well, Nick Clay from Redwheel Global Equity Income Fund, it's been fantastic talking to you.
Thank you very much.
That was Nick Clay, Portfolio Manager at Redwheel, and that's all we've got time for this week. Don't forget you can email us with any questions, comments or suggestions, as we love to hear from you. Email us at podcast@ajbell.co.uk. Leith and Dan will be back with next week's episode, and we'll also have another of our investment trust specials hitting your podcast feeds early next week, so keep an eye out for that. Until next time, thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.